Hello. In this video, we'll be talking about interest capitalization on self-constructed assets. What are self-constructed assets? Well, we've learned that a company can buy assets, but they can also construct assets for their use. So, because for various reasons, they might decide to build an asset rather than just buy one. And the companies often they act as the main contractor, but they'll subcontract a lot of that work or most of that work. In order to build an asset, whether it's a building or big piece of machinery or facility, a company needs to finance, they need to pay for it. And the way they do that is many times they use a loan. They take out a loan to pay for that. And companies have to pay interest on that loan. The question is, for those interest expenses, how should they be treated for US GAAP? If a company were just to buy, let's just say a building or really expensive piece of equipment, they would take out a loan on it and the interest expense would be expensed on the income statement. However, for self-constructed assets, the difference is that those assets are not ready for intended use. Whereas if a company just purchased an asset, then they could use it right away. Self-constructed asset, they have to be built. So they're not ready for use. And so US GAAP says that the interest costs incurred on loans specifically taken out due to the self-construction are capitalized. And then are capitalized into the cost of the asset. And then once those assets are ready to be used, then the total cost will be depreciated. And that's how eventually those interest costs flow into the income statement. So which assets qualify for interest capitalization? Well, it's the assets that are constructed for a company's own use as well as discrete projects for sale. So meaning if a company builds an asset intended for a sale, those can also be considered qualified assets. And it's only for interest incurred during the construction period. That's the only time that they're eligible to be capitalized. And the construction, the period of capitalization it starts when the construction begins and the first expenditure is made, and ends when the asset is substantially complete and ready for use. So any interest incurred between the time it first starts and the time that it's substantially completed and ready for use, that period of time, anytime the interest is accrued, it is capitalized into the cost of the asset. And again, the capitalized amount of interest is only the portion of this language says, only the portion of interest that could have been avoided if expenditure has not been made, which basically means the capitalized amount is only for loans that are taken out for purpose to finance the construction. If those loans were taken out in any case, whether there was construction or not, then in that case, those interest expenses are not capitalized. Let's go through a example. On January 1, 2027, the Mills Conveying Equipment Company began construction of a building to be used as its office headquarters. The building was completed on June 30th the following year, 2028, and the expenditures on the project, which were mainly payments to subcontracts, were as follows. So, as typical in a construction project, the costs are not incurred evenly throughout the year. There's chunks incurred throughout the year. So in this example, on January 1, the company incurred $500,000 worth of cost. On March 31, $400,000, and on September 30th of 2027, $600,000. So for 2027, the company incurred $1.5 million in total. That is before any capitalization of interest incurred. And then in the following year, they incurred $600,000 on January 31st and $300,000 on April 30th. So in the beginning of the construction project on January 1, 2027, the company obtained a $1 million construction loan with an 8% interest. This means that this loan was specifically taken out to fund this construction. The loan was outstanding the entire construction period, and the company had other interest-bearing debt or loans of $2 million and $4 million with interest rates of 6% and 12% respectively, and those debts were also outstanding during the entire construction period. So first step, when you're seeing how much interest can be capitalized, is to determine what expenditures, meaning what amount of costs can we calculate interest on. So if the costs were incurred evenly, fairly evenly throughout the period, then you take the average, which if we're taking a $1.5 million incurred for 2027, then our beginning cost was 0. Our end of the year cost was 1.5 million, right? And then you divide that by 2, and you had your average accumulated expenditures was $750,000, and you would calculate the interest on the $750,000. Now, usually that doesn't happen, right? The costs don't get incurred evenly throughout the year, but they get incurred in chunks. So now we have to calculate what's called the weighted average accumulated expenditures. So we have to weigh them depending on how long they were outstanding, those costs were outstanding throughout the year. So on January 1, 2027, the company incurred $500,000. And this is for the full year of 2027. So they were outstanding, those portion of the costs were outstanding 12 out of 12 months. So that is the weighted expenditure is the $500,000. On March 31st, they incurred another $400,000. And now those costs were outstanding for 9 months of the year, right? Because they're outstanding for April through December. And so that will give us $300,000. And then on September 30th, they incurred $600,000, which is only that cost was outstanding only for 3 months, the last 3 months of the year. So that weighted average is that weighted expenditure is $150,000. So out of the $1.5 million incurred for the year, when we take the weighted average based on the time that was outstanding, we have $950,000 of weighted average accumulated expenditures. That's what it's called. And there's 2 ways to calculate the interest on that $950,000. The first one is called the weighted average interest method. And that the weighted average interest method is used when there is no debt, when outstanding debt is not specifically designated for a construction project. So it's just if the company has debt in general and they're using that debt for the construction, but they didn't actually take it out specifically for the construction project, then we use the weighted average interest method, which the problem told us they had $2 million at 6%. They had a note payable, I think it was. And so that causes interest to be $120,000 for the full year. And they also had another loan at $4 million at 12%, and that's $480,000 of interest for the year, giving us $600,000 of interest expense for the year incurred from these other non-specific construction loans. And so what you do is you take the interest expense for the year from those 2 loans divided by the total principal of those loans, which is the $6 million, and we get 10%. And what we would do is we would take our 950,000 weighted average, the weighted average accumulated expenditure number, that 950,000, multiply by that 10%, and we get interest expense interest that could potentially be capitalized for $95,000. So that's step 1. The second step is you can only take the lower of the calculated interest versus the actual interest incurred. So the actual interest incurred from these two loans is the 120 plus 480 is $600,000 is actual interest. The calculated interest is 95, so it's only $95,000 would be capitalized under this weighted average interest method. There's another way to calculate the interest capitalization amount, and that's called the specific interest method. And that is used when there is a specific construction loan. And we were told in the problem that the company took out a $1 million loan specific for construction, and the interest rate on it was 8%. So since we incurred an average expenditures of $950,000 for 2027, and that entire $1 million would be able to be covered under the 950, we just take the full amount 950 times 8% and we get $76,000. So this is the potential amount that we could capitalize. And then again, we have to take the lower of the two costs, the lower of the calculated interest versus the actual interest. The calculated interest is $76,000. That's the 950 times 8%. The actual interest would actually now be consisting of 3 loans because the specific interest method is only used when we have a specific loan for construction. So on top of calculating the interest for the 2 million and the 4 million as we did before, we're also going to add in the interest for the $1 million loan, which was outstanding for the full year. So we're just going to use that annual amount of 8%. So our actual interest for the full year is 80,000 plus 120 plus 480, which is 680. And you take the lesser of the two, which is going to be the $76,000. So this is the amount that's going to be capitalized as part of the cost of the asset. I'm going to go up here. When we look at the cost of the building, the expenditures that we incurred for 2027 was $1.5 million. That was told to us in the problem. Plus, now we have interest capitalized for 2027. You add in the $76,000. And so now your accumulated expenditures at 12/31/2027 is 1576. Now we're going to go on to 2028. So step 1 of 2028 is we have to determine, again, the weighted average accumulated expenditures for 2028. The problem told us that the building was complete on June 30th of 2028. So it's important to keep in mind that this is only for half a year. So determining the weighted average accumulated expenditures. So we have to take into account any costs prior to the current year that we're calculating. So we have to bring in the 2027 cost, right? The beginning, which was the 1576. Plus, we incurred $600,000 on January 31st of 28 and $300,000 on April 30th, 2028. Their total expenditures was 2476. However, these numbers have to be weighted as follows. The 1576 was outstanding for the full portion of the year until such time that the asset is complete. So remember, the asset was complete on June 30th, so we're only calculating this for the 6 months of the year. So the 1576 was outstanding for 6 months, for 6 out of 6 months. So that weight is the full amount, 1576. The $600,000 that they incurred on January 31st was only outstanding for 5 out of the 6 months, so that becomes 500,000. And the $300,000 incurred on April 30th was only outstanding for the 2 months, for the month of April and for the month of May and June. So that gives us 100,000. So our total weighted expenditures is 2176. So notice when you just add in all the expenditures, it was 2476. But when you take in the factor of how long was outstanding, like when the costs were incurred, the weighted average, accumulated weighted average was 2176. So that's step 1. Step 2 is we have to compute the capitalized interest for the 2176 that we calculated. Okay, so our total expenditures is 2.176. And we know that we borrowed $1 million. We had a $1 million construction loan specifically for the construction at 8%. And the loan, remember, this is for 2028. So the building was completed on June 30th. So the portion of the year that this loan was outstanding was only for 6 months. So that calculated interest is $40,000. However, we have total expenditures of 2.176 that we need to calculate interest on. This takes care of $1 million, and we have another 1176 that we still have to account for. So what rate, right here, what rate do we use for the remaining excess over the specific construction loan amount? Well, we're going to go back into our weighted average interest method calculation, and we're going to we do this again only for outstanding debt that's not specifically designated for the construction project. So remember, this doesn't have the $1 million in the calculation because we've already allocated that $1 million right here. We've already used that $1 million loan. So the interest rate from the $1 million loan. So back to this calculation, we know that the weighted average rate was 10%. And so that's the number right here that we're going to use to calculate the interest on the excess amount more than the specific borrowing. And again, it's outstanding for only 6 months, half the year, and that gives us $58,000. So now when we add those two, the 40,000 plus 58,800, we have $98,800 of interest, potential interest to be capitalized in 2028. You still have to go to step 3, which is right here, step 3. You have to compare the calculated interest, the 98,800, to the actual interest that was outstanding for the entire year. This does include the construction loan amount. And when we look at that, the actual interest for all those loans is $340,000. So 98,800 is the lower of the two, and so we would capitalize 98,800 into the cost of this asset on June 30th, 2028. Let's do a concept check. In January 2027, the Mateo Company began construction of its own storage facility. During 2027, $13 million in construction costs were incurred as followed. On 1/1, we had $2 million. On 3/31, I should say, was $4 million. On June 30th we incurred another $4 million. And on 10/31 was $3 million. And then it says Mateo took out a $4 million 10% construction loan, so that's specific for the construction at the beginning of the year. And the company had $20 million in other interest-bearing debt with a weighted average interest rate of 8%. So we need to figure out the weighted average accumulated expense. So we're going to take each of these cost amount and weigh them for the amount of time that they're outstanding for the year. So the $2 million was incurred on 1/1, so it was outstanding for the entire year, so that's $2 million. The $4 million was outstanding for 9 months out of the year, so that would be a weighted average of $3 million, and this $4 million incurred on June 30th was only outstanding for half the year from July 1 to December 31. So that would be $2 million. And the final $3 million incurred on October 31st was only outstanding for last 2 months of the year. So that means that gives us $500,000. When we add that all up, we have $7.5 million. This is the weighted average accumulated expense. So that's just step one, right? And then step two is we have to figure out of the $7.5 million average expenditures, how much of that, how much interest can we capitalize on that amount? So I'm going to erase all this stuff just so I have more room on this page. So I erased that all that detail, but that $7.5 million of weighted average accumulated expense is broken up. First, we took a construction loan of $4 million at 10% equals, sorry, that was equals $400,000. And so that leaves us with $3.5 million of expenditures that we also have to calculate interest on. And for the remaining, the excess above what the construction loan was for is going to be taken at the weighted average interest rate. The problem already tells us it's 8%, but in the previous slides, we had to calculate how to get to that 8%. But we're going to take that 3.5 times 8%, and that's going to give us $280,000. So on that $7.5 million, the weighted average interest is $680,000. Now, the step three is really you take the $680,000 interest capitalized potentially, and it has to be the lower of the 680 or the total interest for the year, which would have been the 4 million times 10%, which would have given us $400,000 plus 20 million times 8%. And I didn't actually do that math, but it's going to be a lot more than 680 because 3.5 times 8% is 280. So 20 million times 8% is going to be more than that. So the problem didn't actually show that final step when you look at the answer, which I'm not going to post because it's very condensed. But the answer is 680,000 will give you the lower of the two amounts.